Hey, it's Navy Dowdy here from the Chicago area in the Midwest and the great United States. Let's talk about tax planning today. The topic is, why didn't my CPA tell me that? When we start tax planning with a new client, the first thing people often ask is why the accountant or CPA or other tax preparer that they are using doesn't think or act the way we do in discussing the hunt for possible tax savings. After all, the current tax preparer is smart, trustworthy, running a successful accounting business, and trusted in the community. So why are we telling them all these wonderful new tax savings ideas that their other tax preparer has never mentioned? There are many explanations, but the simplest is how the accountants themselves view the job that they do. Often, accountants think that the profession of accounting in its simplest form is the job of telling the story of money that has already come in and gone out, and they're reporting history, which is very different than telling a story that will change history. What? Can accountants change history? No, they can't. But the history of money in and out doesn't end when the event itself happens. It ends the day the accounting is sent to a taxing authority. And even after it is sent, it can still be changed again. For instance, a business owner who buys a $50,000 delivery truck for 100% business use, and the accountant puts the truck in a standard recovery period of 5 years, basically reducing approximately $10,000 per year of the company's taxable income for the next 5 years. The company then has a great year after the owner's personal taxes are completed. He ends up with the highest tax bill he has ever been faced with. The CPA recommends putting money that the owner would rather keep in order to expand the business into an IRA to lower the owner's tax bill. He is told that's all you can do at this point. However, that is actually not all that can be done, since the IRS allows accelerated depreciation, which means the owner could amend the corporate 1120S and elect to take the entire $50,000 as depreciation for the delivery truck, all in the current tax year. So rather than having to fund the IRA, he can now use that cash flow to expand the business as he desired. Many tax preparers are almost robotic when it comes to simple tax planning. Often they decide for the business owners what's best for them, instead of explaining more and working in tandem with them. Many accountants see the job of accounting in a very narrow view, and looking around for additional tax savings, or even more so, changing business practices in order to lower the future bill is not the job that they were hired to do. However, we think this is a very important part of any good tax plan. That's why our firm states proudly that we are proactive tax planners. Of course, it's not always the tax preparer's fault. If you walk into a tax preparer on, say, April 10th and dump on their desk all your papers spread out all over the place, and then expect them to get it all done while you wait, that's going to be pretty tough at that time of the year. What's the catch? Why wouldn't everyone use tax planners? Mainly because tax planning comes at a terrible cost that most people just do not feel that they can afford. Time. Time answering questions, gathering documents, and discussing and learning enough about the recommended changes to affect tax savings. Time learning something new. The cost is time, and everybody is already busy. Our question to you is, what is your time worth? If we had a 30-minute meeting to review your last 2 years' tax returns, then a follow-up meeting with an hour of sharing plans on how to pay less tax in the future, and then up to 2.5 more hours over a few weeks or months educating your current tax preparer and setting up new processes, and all you saved was $4,000, let's say, would it be worth it? Well, that's $1,000 an hour for your time. What if you are a business owner? The time is often the same, and the savings can be $40,000 or more. Would that time be worth $10,000 an hour? I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.